Good morning, good afternoon. Welcome everyone to our fourth quarter analysis of the NCREIF ODCE Index call. This is now our fourth quarterly call in a row, and we're currently expecting over 400 participants today. So again, welcome and thank you all for attending. Just as a quick reminder, the performance information that you're going to be seeing today is representative of NCREIF's entire ODCE Index, which covers 27 funds. The valuation data presented, that's reflective of not only the 25 ODCE funds that we work with, but it also includes insights on the over 10,000 valuations that we oversee each quarter on assets totaling in excess of $900 billion of gross asset value. We will allow about 10 minutes at the end to answer any questions you may have. So there is a chat feature on here, so feel free to enter your questions and we'll make sure and get to them at the end. And final note is we do this quarterly. So the next webinar, you can put it on your calendars for May 5th, and that'll cover first quarter results that are occurring right now. So again, thank you for joining. And with that, I'll pass it to Phil and Robbie and get back to you with questions at the end.
Thanks very much, Rick, and thanks everyone for joining the call today. Just set out what we're reviewing. This presentation focused on the pure real estate side of the ODCE, so there's no leverage in the numbers we're presenting. So we're looking at how the actual real estate performance levels have played out over the period of the pandemic. And just first off on my side, thanks everybody, A, for joining the call, B, everyone for working around all this data on the client side and both internally within Alters. I know it's a monumental effort to get this done on time, so we very much appreciate it. So let's start with some of those headline numbers. So what we're seeing here are the total return numbers, that's income and appreciation. The table tracks back to the onset of the pandemic. So midway through 2020 is when those returns turned negative, and since then the market's been fixed firmly on an upwards trajectory, setting record rates of return quarter over quarter through the course of the last year, which is making the downside of the pandemic start to feel like an increasingly distant memory from a return standpoint. But there's lots of variations within these levels. We plan to unravel that, myself and Robbie, over the course of the next 15 minutes. Those returns rose to a record 6.8% in Q4. That's a shade lower on an operating asset base at 6.6%. That's the inclusion of developments adding about a 20 basis point premium to performance levels. But either way, look over from the prior quarter, returns are up by about a percentage point. What we're doing here on the sectors, we're color coding those vis-a-vis how they're performing in relation to that obviously overall average. So you've got that green swathe that runs through the middle. The industrials and logistics, clearly the beneficiaries of the last 2 years, and largely at the expense of the retail sector. That trade-off was in place way before, but has been exacerbated during the course of the pandemic. Then you have apartments gaining the upper hand over the offices. So you kind of go back to Q1 2020, kind of 1.1% return, 1.2% return, so pretty much level set. You go forward to this quarter, offices are pretty much at that same level, but the apartments returns have risen to 6.8% in Q4, and apartments really taken off in the second half of last year, but that's still very much eclipsed by what's been happening in the industrial sector, registering a near 15% return for the quarter. The other strong suit are others, which is mainly storage within that's bolstering that return up to 9% in Q4. And each of those, let's call them the growth sectors, the apartments, the industrials, and the others, they're upping their returns over the last 3 months. Whereas at the low down the hierarchy, the offices and the retails are kind of stuttering along, edging downwards actually in the final 3 months of last year. Still some positive appreciation in those return numbers for offices and retails, and certainly ahead of where they were this time last year. If you separate out the pandemic into its two halves, into those two annual rates of return columns here and here, 2020 clearly was when all the damage was done. 2021 has been characterized by some stability at the lower end of the order and some record high rates of growth at the top end, culminating in a record 19% rate of return for the year. That said, it's a period of huge disparity that we find ourselves in at the moment. You see that in that sector spread of 40 percentage points from industrials down to the retail sector, and there are significant variations within the sectors that we'll get into the detail of. Sticking with the sector analysis, this just looks at appreciation levels of return over the last 2 years. I wanted to illustrate here where values are in relation to where they were at the start of the pandemic. That's the numbers alongside those two annual time period bars. And you can see quite a different set of circumstances being played out here. First off, on the right-hand side, those kind of write-downs of 2020 and those grey bars have been totally overshadowed by the growth the market has seen in 2021. So values of commercial real estate are up 11.3%. They're up higher than 11.3% since where they were at the start of the pandemic. Retail and office values are still net down. Office values coming back a shade in the last 12 months. Retail's still down a shade, but most of the damage being done in 2020. Apartments have kind of come out the other side of the pandemic on a very strong footing. Values are up kind of 15% in the last year and net up 12.6% overall since the start of the pandemic. Other, which is mainly storage, didn't suffer really any setback during the onset of the pandemic. And like industrials, but maybe not to the same order of magnitude, have been clear beneficiaries through this period. So what has all that done to the portfolio structures? I think I recall from my geography days, this is called a sand diagram. So we extend the time series here back to the start of the Odyssey property performance series, kind of the 2013. And during this period, to where we are now, weightings have changed significantly. So those green bars, the industrial weights have gone from 14 up to over 0.25% of the value of these portfolios. Offices, the purple bars have gone from where they were close to 40 down to below 30%. Retail's dropping below 12%. That office cutback has been quite significant during the course of the pandemic. Maybe seeing more trades there than we have in the retail sector. Apartments holding relatively steady, but up to about 27%, and then the new kids on the block growing up to 5% in that other sector where we include storage. I know, Robbie, you've done a bit more digging into these numbers, so certainly around the investment statistics. So did you want to add anything to that one?
Yeah, sure, Phil. I think that the overall decline in the share in the office, right? So both with the lagging appreciation in that sector versus the industrial and apartment. The other thing as well, what we notice is a sizable disposition, right? So if you look at it over the past 4 quarters, the disposition is about like 1 to 3 billion per quarter, right? So in this Odyssey index, right? So and then on the retail front, we've seen that the transaction also pick up. The overall disposition, it was in third quarters about 200 million. It's up to like 1.4 billion now. So we can definitely see both the disposition side on that, and also the lagging in appreciation in both retail and office.
Okay, thanks there, Robbie. And we'll come back to maybe reference on those transactions as well when we start to look at where pricing levels have gone as well, but more on that later. Back to the top level, this chart puts into context the kind of uncharted territory the market now finds itself in. So what we've seen playing out certainly over the last 3 quarters overshadows the write-downs of 2020. Appreciation returns kind of had been doubling up quarter over quarter and still continue to strengthen in the final 3 months of the year, and that's marked out by those red bars. And we're witnessing levels of return which in previous periods took almost a year to play out, which are now being delivered in the space of an individual quarter. And within those overall numbers, now the market's still delivering out an income return of about 1%, which is clearly a key attraction to investors. But Robbie, maybe just your kind of top level thoughts about what's triggering such a rally at this point in time.
Yeah, and then it showed the strength of the economy, right? With the overall reopening, which we'll dissect later on as well, that helped the fundamental of real estate, right? So on the fundamental side, and then with low interest rate environment, and you have increased investor demand, that helped the capital market side. So you see that both fundamental and capital market have a play into it and make it a strengthening of the return over the past several quarters.
Yeah,
not all sector created equal, right? So I mean, so not all sector created equal. I know later on we're going to dissect more of it. Yeah. Some have benefit more than the other. Right, so. Yeah,
sure. Yeah, we'll definitely cut into that. And you're right. I mean, those economics versus the kind of capital markets side of the numbers were kind of ideally placed with our valuation data set. So actually, nice segue, because transposing that red line there, so the red bars into the red line, we're now bifurcating the appreciation part of the return into kind of what's termed the yield versus the cash flow drivers. So Just for a recap for folks that are familiar with this, and for anyone that's new to this, the yield effect here is the impact of what might be termed the pure pricing levels on value. That's the change in discount rates and exit caps. That's maybe where the investor sentiment, the capital markets part of the equation comes through. The cash flows, which are the blue bars, are identifying the impact on value from the change in the forward projected cash flow. So that's more the fundamental side of that. The capital expenditure, the grey bars, also the third layer, needs to be noted, because you don't bank all that change in value from a return standpoint. That 5.6% appreciation is the change in value net of the money being spent on properties during that measurement period. And it's interesting to note that capital piece has eked up quarter over quarter, so possibly seeing a need for investors to invest a little bit more in their properties in the wake of the pandemic. Leaving the capital expenditure aside and focusing just on the interplay between the yellow and the blue, the yield and the cash flow, taking the narrative back to 2020, it's the reduction in the cash flow levels primarily that took the value south at the onset of the pandemic. The recovery is then initially investor sentiment driven, and that hasn't dropped off, as you see the size of those yellow bars going forward over the next 4 to 5 quarters. But it's the market fundamentals, those blue bars, that are now increasingly becoming the key component of growth. Put into proportional terms, it's about a 65-35 split between fundamentals versus capital markets, driving up those values to record levels. But as Robbie says, that there's a whole set of different circumstances that play out across the different sectors that feed into those numbers. So let's move across those. So the same analysis here, but run across different sectors. And you want to be focusing on the right-hand side of these charts. And we've kept the scaling here uniform across the 4 charts, just to showcase how the narrative for each of the sectors is really being dwarfed by what's been playing out in the industrial sector. So let's start there first of all. Here, growth has been pretty much unrelenting quarter over quarter. Appreciation levels, even more so than on the prior slide, are kind of cash flow driven. The pure pricing gains, those yellows, haven't let up, but it's the cash flow component that's been increasing. And now we're seeing about a 70-30 split in terms of cash flows versus yields, taking those appreciation levels up to record positions. And clearly those rents are hitting record levels almost on a daily basis. If we substitute out on that top chart there the industrials for the other sector, which is mainly storage, that then allows us to rescale those charts, making it a little easier to identify trends in all the other sectors. Appreciation, sticking with other, is around similar variance there between a 70-30 split, cash flow versus pricing. Here, demand drivers will kind of clearly been exacerbated with the transient nature of the workforce during the pandemic, maximizing utilization of storage facilities, and that's the main property type driving growth in this sector. If you move across to the apartments, cash flow levels here, the blue bars, they were initially scaled back, but now very much back on the rise, albeit with variances across geographies and submarkets. But those cash flows are recovering some of those losses, and indeed improving to record levels in some of those market hotspots that we will move on to. And throughout, there's really been no let up in investor demand, providing that positive pricing support, which has initially helped protect values when cash flows were being eroded away. And they're now combining with those cash flows, positive cash flows, a dual positive, providing those record levels of appreciation that we've seen towards the back end of last year. Offices down below, pretty nondescript in the wider scheme of things, but these are overall levels, and that masks a whole host of variances we'll get into when we analyze things across regions and more localized markets. Most of the variance is on those blue bars, the cash flows, which have just turned positive over the last couple of quarters, but are still net down when you see over the period of the pandemic. We've also seen some positive pure price adjustments, those yellow bars above the line, coming through in the last couple of quarters. I'm curious, Robbie, to get your thoughts on those green shoots, but maybe we'll park that until we get into the detail within the sector, and just kind of finish off with this slide looking at the retails. I mean, the headwinds here have clearly eased. It's a sector that's been through understandably a torrid period of correction from a yield and the cash flow standpoint. The last quarter, though, we started to see just a little bit of positive pricing adjustment coming through in the last couple of quarters, some green shoots there on the cash flow side of things. So again, Robbie, maybe interesting to get that narrative going when we look at the different subtypes later on. Let's take a slightly deeper dive into those numbers there. So here we're sticking with the last quarter, looking at that appreciation breakdown across the major food groups, ordering them in rank order. And the top and the bottom end of the order are definitely separated both on a yield and a cash flow perspective. It's kind of a case of the haves and the have-nots. The have-nots, the offices and the retails in terms of relative movement there, the haves, the industrials, the other, and the apartments. But everything, though, positively is sitting to the right-hand side of the zero line, although it's pretty minimal in the case of the retails and offices. Industrials up top leading from both a yield and a cash flow perspective. Most of the variance between the different food groups is on those blue bars, the cash flow side of the equation, so we can pick that apart. And this type of analysis we run for each of our clients that work with us around the portfolio analysis service. They get access to this on their own portfolios. And here we're relaying that kind of cash flow aspect of appreciation across 6 key valuation metrics that come from our value data set. There's no perfect science here to this, but the color coding does give you a sense of what's having a positive or negative impact on those cash flow influences on value. So we're showing the percentage change here in each of those metrics over the last quarter, and it's predominantly greens across the board. The main variance from top to bottom is the improvements in these upfront face market rents. That's improvements there clearly evident for the industrials, the other mainly storage, the apartments, and pretty non-existent there for offices and retails actually down a shade as they are in terms of contract rents. Projected growth rates are all trending in the right direction across all sectors, and we can break their 10-year rates, so we can break those down into year 1, 2, and 3, and most of those gains are in year 1, but we're also seeing that coming through in year 2, less so in year 3. Some of that is picking up some downside from 2020, and we'll look into that. Picking up some other pointers, maybe on the occupancy side, there's still reduction there on the offices and the retails. Maybe Robbie, on the occupancy side, there's a surprise. Do you expect more of that fall off on the office side, especially given businesses' consideration about downsizing their space and requirements, or do we take positives from the fact that that's pretty minor?
It is one pretty minor, but it is show also the uncertainty on that 2 sector, right? So with office opening and then with Omicron kind of delay opening, right? So that's continued the unknown on the office and retail sector that's kind of reflecting it, right? So so I'm not going to worry too much about it. It's something we have to monitor, but definitely there's always continue to be that question, right? So, but with Omicron, definitely delay this certainty, right? We're still trying to figure out what's going on as well. So, but yeah.
Sure. The other metric maybe worth talking to is this year 1 operating expense ratio. This metric measures the change in the ratio of year 1 projected operating expense as a percentage of the year 1 gross anticipated rent. So, and how that ratio has changed over the course. So maybe no surprise by offices, a slight increase in that, we'll call it a net deficit there with a red bar, as I guess kind of further rent concessions are still coming into play there. Industrials took me a little bit by surprise, the fact that that was out in the red zone, given that the rental increases we're seeing there. So I guess that's more on the cost side. And I guess, well, is that something to be worried about, Robbie? Your thoughts on that?
Yeah, the expense side on property tax, right? So with value go up, your property tax will go up. So it's kind of expected on that basis. But the good part is all industrial are mostly triple net, right? So sure. All the expenses are passed through to the tenant. So the impact to the value is pretty minor, right? So, right. But it is something to kind of continue to monitor. How is that cost then relay that back to the tenant, right? So
Sure. Okay. And then the final metric there on the right-hand side is the capital expense ratio. So this looks at kind of budgeted capital costs as a percentage value and how that ratio changes over the quarter. And it's been edging outwards, particularly on the office side, but also on the apartments and the retails. And I guess this is a sense of investors realizing they're needing to invest more into their assets to ensure they remain competitive given the change in the overall circumstance of the market landscape. This is for the quarter, so maybe let's look at these results over a 2-year period. And there's some real clear-cut variances from the top of the bottom end of the order. So now we're looking at the percentage point change in where these metrics are now versus where they were at the start or before the pandemic back in Q4 2019. So first of all, the top 3 characterized by improvements in market rent over the period of the pandemic, whereas no real change for offices and retail. Offices up a smidgen in terms of market rents, but that's clearly been offset by the reduction in growth rates, and that reduction in growth rates is clearly evident there in year 1 for offices and retails. It continues through being below where it was in year 2 and year 3 pre-pandemic, but offices actually, their growth rates for year 2 and year 3 are actually now ahead of where they were before the pandemic. So maybe a bit of a positive sign there in terms of predicting a rebound in the economy post-COVID, but the retails are still kind of marking themselves down. If we actually zero in on those year 1 variances in terms of where growth rates are now for the year 1 versus where they were pre-pandemic, I mean, industrials have really taken off. Growth rates now at kind of 5%. That's about almost 2% higher than they were pre-pandemic in year 1. Apartments are up by about 50 bips. But that office year 1 is down by 1.3. The retail is down by about 1.6. And also, you've got this tilt out in this operating expense ratio. So that's the concessions with kind of reducing expected rent levels, pushing out leasing assumptions. And so the effects of the pandemic still very much being felt in that regard. And I guess to your point, probably also the jump in costs with the kind of that wider inflationary story also eating into that metric as well. And then on the right-hand side, you have this capital expense ratio again over a 2-year period, and that's certainly moved out for offices and retail. So realization to invest more into those sectors than was the case before the pandemic to ensure that some of those assets remain competitive. Okay. Let's change gears now and move back up to the overall return levels, focusing on the differences across the different metropolitan markets. So we've ordered these from east to west in terms of the 15 largest, and into the other grouping is maybe what might be termed the non-primaries. The color coding first off here looks at everything in relation to the 6.6% return. So it shows how the market is kind of pretty binary in that it's the industrials that are accretive to performance levels with a lot of most of the others, whereas offices and retails, reds across the board in terms of their inclusion of those assets is generally tempering down overall Odyssey returns. And there's a mixed picture on the apartments between the kind of Sunbelt and gateway markets. But I do want to change the color coding up there a little bit because I want to more focus on the variances within the sectors. So the reds and greens change a little bit now. So now these color codings are in relation to those sector averages. So DC industrials are 13.4. That's gone into the red zone because it's below the sector average for industrials, whereas New York is green, it's above. Atlanta is now green for offices because it's higher than the average for offices, whereas Chicago is still in the red zone. And then the bottom table looks at how the returns up top differ from where they were in Q3. Greens and reds above or below where they were. And it's kind of a case of the haves and the haves not. So the markets that are up front in their sectors in green up top are generally seeing some improvement in performance level. It's a broad generalization, whereas the pressure points are seeing some slowdown in return levels. I mean, that's a sweeping generalization. So let's maybe take each sector one at a turn and look at maybe the apartments first. So this is Q4. So once again, the lead performers here are those Sunbelt markets, the Atlantas, the Miamis, those Southern California markets, and also into that other grouping, which has a relatively high proportion of Sunbelt type locations. If you look at the differences then against Q3, the Sunbelt markets are typically on the rise, reporting even larger gains. The gateways are typically being lowered. And this is kind of different from what we reported back in the Q3 position, where we saw all markets move up between Q2 and Q3. So, Robbie, I didn't know if there's anything to read into that in terms of the maybe Omicron kind of just as slight setback to those trends that we had started to see with those gateways picking up, but they've now dropped back again. So any thoughts on that?
Yeah, it might have some impact, but I think the biggest impact is that seasonality, right? So if you look at it, New York, Boston, Chicago, generally the CBD market are located, I would call it the more extreme climate, right? So you have less move in, move out. We connect on the fourth quarter being the winter month with the holiday as well. So you definitely have some seasonality in that aspect, right? So versus the Sun Belt, which is more, I call it mild or temperate climate, right? So you have less seasonality with the weather, and then you have the migration that we're going to talk about it as well. That's going on in that market. That's still going to see an increase in the market rent side, right? So I would say some Omicron with kind of delay opening, but majority of it I would say due to that seasonality.
Right. Okay. So delving, sticking with apartments, delving a little bit deeper into these variations. This next slide just takes the appreciation element of those returns. It's focused on just the Q4. So first thing to note is values up across all metropolitan markets. There's definitely that divide opening up between the Sunbelts and the gateway. What's behind those variances on capital markets are pretty much level set in terms of the impact that those pricing adjustments are having across the hierarchy, and really it's the cash flows that are differentiating the top from the bottom end of the order. Those Sunbelt markets are up top at the top end of the order, and the cash flow has been the mainstay of the value increases there, and they've seen the larger improvements in those kind of market rents that sit behind that. Contrast that with lower down the order, the Chicagos, the New Yorks, and San Franciscos, seeing pretty muted improvements in market rents and also pretty muted improvements in contract rents. And you can also kind of draw a relationship with those market rent growth rates as well, although some of the rates lower down the order stepping up a little bit more, having been hit a little harder in 2020. That's for the 1 quarter. If we look over a 2-year period, there is a little bit of pricing variant coming in, differentiating the top from the bottom end of the order. And those cash flow trends are even more, say, accentuated over the 2 years. What we're showing here, cash flows at the bottom 4 are all effectively net down compared to where they were pre-pandemic. Remembering these charts go back to Q4 2021 in that respect. And you can see a definite divide there between the top and the bottom end of the order. And at the top end of the order, you've got improvements in market rents in Phoenix, kind of up in the high teens, Miami kind of near 10%, whereas lower down the order, muted in terms of market rent change. And actually, over the period of the pandemic, some red bars, market rents and contract rents net down on where they were pre the pandemic. Adding to that the headwinds associated with this year 1 operating expense ratio, and you can definitely see how those cash flow positions at the bottom have been eroded, but they're positive up top because of the strength on the rental side. So, Robbie, maybe you'll read on here in terms of, can we expect a revival on those gateway markets down below? And I know you've done some additional work on this, looking at the data from the Stratton side of our organisation. So do you want me to move on to that?
Yeah, maybe just move on to the next slide, Phil. That will help as well, right? So, yeah, with Stratton, which we just now part of Alta since May 2021, right? So now we can quantify the why of the overall performance of various asset type, right? So using alternative data set, mobile data set, traffic, and various different economic data set as well, right? So in here example, we just use kind of multifamily. Simple one-to-one relationship just to illustrate the various relationship out there, right? So if you look at a property in less dense neighborhood, so we're taking the neighborhood within kind of half a mile radius from the subject property, right? So if your property in less dense neighborhood, you tend to outperform, right? So, and then your property located in strong population growth, definitely also stronger performer as well, right? So the one on the right side. So the other thing as well people don't think about is diversity of employment. So in here, what we found out that matter as well. So the diversity of employment, more diverse employment is actually better the performance as well for the property, right? So and then we talk about the overall recovery, right? Using the traffic data. So in the neighborhood that's stronger recovery. So either you can connect back from previously or the net migration as well. That help as well the performance. So again, this is taking one-to-one relationship, right? So you go to the next slide, Phil. Now you're taking it all this factor into a heat map, right? So then we can kind of see it. Okay, so what matter in here? If you look at it, the one that a lot of green are Phoenix and Inland Empire, right? So in here, market with low multifamily supply growth, like Inland Empire, that's going to be outperformed, right? So employment diversity, as we talk about, like again, this within the immediate kind of neighborhood from the subject property, right? So it's not kind of the higher metro area, but within the property within that others index. In there as well, showing the employment diversity also outperform, right? So if you're in the dense neighborhood, like the green, which is the Chicago and the New York, right? So there's a big red there, right? So the denser it is, there's a negative impact, right? So, and also urban versus suburban. So yeah, generally taking all this thing, now we can identify why certain asset and certain market can outperform, right? So we know that employment growth, population growth, but on the other hand, higher density is actually negative. Urban have been negative for the apartment.
Yeah, and it's certainly been a major asset to us in terms of having this data to understand what sits behind that kind of the financial data that now we're interpreting in those valuations, and taking this forward and putting it in front of our clients and analysing their performance against these metrics, I think is taking it to the next level. So we'll certainly be in discussion with clients over the course of the next coming weeks. So interested in it, please do get in contact with us. Let's move across to the industrial sector now. So industrials, the real standouts here again, those Southern California markets, they're the ones that are stealing the headlines in terms of those top rates of return. LA now taking the top spot from Inland Empire with a, what's that, eye-watering 21.3% return. Back at the upper end was also New York, New Jersey region, so it's kind of high teens there, 17.1% rate of return. And these markets are far ahead of everything else on the industrial spectrum, which is kind of why you have that color coding of everything else in red. But I think for industrials, you want to look down here in terms of the change between Q1 and so between Q4 and Q3, because pretty much most markets are strengthening in terms of seeing gains over Q3. And up the top in terms of return levels, it's only really Denver, Houston, and Chicago that are sub 10%, and we're still talking only 3-month rates of return, and returns even there in the high single digits. If we break that down, so for sticking with just the Q4 numbers, for industrials, that variant in terms of appreciation from high to low is primarily on the cash flow side, those blue bars, as opposed to the yellow bars, and it's really being dictated by changes in market rents, and that's really what's been spearheading the rise of some of those kind of those New York, the Inland Empire, and LA markets, whereas now Denver, Houston, Chicago, those market rent levels are relatively low and minimal. Growth rates up across the board, but as with yield changes, that doesn't really determine the hierarchy in the last quarter. It's already on the changes in market rent levels. If you look over a 2-year time period, that cash flow aspect is kind of dual in terms of it's both the variant in market rents and also the variant in growth rates when we're looking across the whole period of the pandemic, determining that hierarchy. So staggering numbers up top there. Riverside, Inland Empire, market rent change up at 60% there. Los Angeles, New York, 30% gains compared with single-digit improvements at the bottom end of the order. And if you compare the growth rates here, and actually I looked into the year one numbers that sit behind these, and I think Riverside was up at 6.4, LA was up, growth rate in year one of 5.7, New York, New Jersey was 5.6, Chicago Denver, Houston down the lower end are all still in the 3% bracket. So, Robbie, what's the for you the narrative that's behind those Southern California and that New York, New Jersey, kind of really at the upper end of the echelons in that respect?
Yeah, I feel like I'm reporting weather from Southern California for the past several quarters now, right? It's nice, warm, and sunny for industrial in Southern California. Where I am in Chicago, it's like snowy and cold, right? So Chicago have been the bottom in the last two sectors earlier we've seen, right? So I think that the industrial side is going to be we all know, right? So the supply chain, the demand for the industrial side, and then in the coastal market, right? So the vacancy rate, you look at the strong demand, the vacancy rate in Riverside Inland Empire is less than 1%, like 0.7%, right? So the LA, Orange County, that's like 1.5%. And look at the New York, New Jersey market, it's like less than 3%, right? So I'll look at it, the market with low vacancy, strong demand, and limited new supply as well in the coastal market. So that's why you can see that the fundamental, the market rent growth continue to kind of move up, right? So versus the Chicago, what I call the non-coastal market, that you have more supply, so the rent did not go up as much in that market.
Oh, yeah, pure fundamentals then. Thanks, Robbie. Let's move over to the offices then. Down the bottom here, not a great deal of change really over between Q3 and Q4, although Boston's come down. That's been a strong pocket. Seattle's also down from where it was in Q3. I think if folks remember, there were a number of transactions back in Q3 that bolstered the performance number there. Although those markets are still colored up green because they're still in excess of the overall office sector average. On that top table, the lead performers are maybe what's termed those non-primary markets. So a 3.1% return will open that up. Also at Atlanta, seeing some notable gains in the last quarter, and Miami also up there in the green zone, and the usual suspects are propping up the order: the Houstons, the Chicagos, the DCs, and the New Yorks. But if we break the results down and just kind of do that attribution around the appreciation return, do you start to see some positive vibes coming through, some green shoots? And this is just for the last quarter for us to talk about. So first, that kind of positive appreciation across more markets than not in the final 3 months of last year. Outside that bottom grouping, we're seeing kind of a number of markets, a larger number of markets, seeing a strengthening of their overall cash flow levels compared with where they were in Q3. And maybe speak quietly or whisper this one quietly, we've also started to see some positive pricing adjustment moving. So those yield impacts moving in the right direction, providing some support to values in the last quarter. Of note, on the market rent side, you've got market rent strengthening, notably in Atlanta. That's propping up that performance number we talked about. Miami is strong. Boston into those non-primary markets as well. And we've got those market rent growth rates kind of coming back as well. So yeah, maybe a few positive things to talk about. We have an expression in the UK, which is one swallow doesn't make a summer. So if you see a swallow in the sky, don't get too excited. It's not going to be a summer's day tomorrow. That's probably going to rain again. And most markets, although there's an improvement here, most markets on the office side are still in decline over the 2-year period of the pandemic. And if you look at the relationship between yield and cash flow over the last 2 years, you have kind of opposing sets of influences on both those metrics. So on the yield side, positive investor sentiment being directed at Boston, Seattle, those non-primaries, a little bit in San Francisco, but the majority of markets, yields are up on where they were 2 years ago, having a negative impact on values through the period of the pandemic. And some cash flow gains at the top, but clear reductions among the likes of Chicago, New York, Houston, DC at the bottom end. Now, part of that variant on the cash flow is determined by market rents. You've got some market rent improvements in Boston, Seattle, and other, and we talked about in terms of Atlanta, Miami, seeing some gains there. But it's the downside effect. So it's the markets lower down that have suffered the higher vacancies. They've had the higher cutbacks to rent growth rates, and they're still sub where they were pre the start of the pandemic. They've also seen more of a tilt, and it's not here, in that year one operating expense ratio with rent concessions still not being flushed out. And you've got a bit of relationship there going on with that capital expense ratio as well. So the market's down the lower end of the order, seeing maybe a bit more budgeted reinvestment to strategically reposition assets in those markets to remain competitive. So, Robbie, maybe there's a lot there for the offices, and I know it's hotly debated. And we have seen some glimmers of positivity in the last quarter, but clearly there is a divide there as well. So maybe your thoughts just on the office side of things.
Sure. I think if you look at the on 2-year kind of chart, right? So it's mostly the life science kind of market, right? The Boston, the Seattle, right? That's kind of San Francisco. That's kind of cover some of the weakness in the traditional office, right? So in the 2-year period, right? So and then the traditional CBD and the market with high supply, definitely the bottom side of it, right? So if you look at the last quarter one, is kind of a little bit more Sunbelt, right? So we know that there's a lot more transaction. There's a lot more transaction indicated in Atlanta. There's still transaction in the, like if you're in the CBD market, a lot of transaction are called the trophy asset. There's flight to quality as well in both transaction as well as leasing, right? So even you look at Chicago, which again, kind of close to the bottom again, right? So there's transaction there, right? So there's a 110 knot whacker that's kind of recently under contract of being sold for more than $1 billion, right? So a brand new office, and the pricing is a sub-5 pricing, kind of stabilized cap rate as well. So you know that the well-quality office has transaction. Now you start seeing transaction on different market things in there as well, to some proof of kind of in a sense market activity in the office market, even with the uncertainty in the office market.
Okay, thanks. Okay, let's just change tack and look beyond the broader geographic spectrum, focusing on the more immediate localities and subtypes. So blue bars here just to kind of explain what we're looking at. They're the actual returns. These are 2-year rates of returns. They're not to be confused with the numbers down below. Those are the actual percentage weights these groupings account for within the overall Odyssey. That line is the 2-year return benchmark that's set across everything. And maybe let's start with the offices, because I think you referenced there, Robbie. I mean, over 2 years, I mean, the CBD, it's really a case of the CBDs versus the rest. And those rest are split 3 ways: urban, suburban business districts, and suburban. But the CBDs have certainly been the laggards there. Apartments on that left-hand side grouping, there's a clear-cut variance between garden and low-rise. They're actually north of the overall Odyssey return level. That's clearly more suburban versus the high-rise, the more urban type stock. And I know that NCREIF are looking to refine some of that classification. We'll tie in with that later this year. Student housing over the last 2 years, kind of lower down, has actually come back a little bit in the last quarter. We'll show that in a second. Warehousing, already kind of industrial, just coded up as warehousing. I know NCREIF have ambitions to break that down, and we'll follow suit with that. And on the retail side, a clear divide there between the malls and the rest. The malls negative, the rest kind of showing some level of resilience over the period of the pandemic. And into that other grouping, the larger part of that is the self-storage, but interesting there to see the healthcare also kind of on a similar performance footing. Hotels, which are pretty much just a handful of assets. The challenges there are clearly self-evident. This is 2 years. Let's look at it on a 1-year basis and note any changes there. So maybe on the apartments, the fact that low-rise are now kind of level set with gardens, so kind of still very much one and the same in terms of their performance dynamics. High-rise still lower down the order, and that maybe also when you're thinking about Q4 goes back to maybe what you were saying, Robbie, before about those kind of gateway markets still suffering those setbacks in Q4. And on the offices, suburban stock starting to come into its own, and CBD markets still muted, more so than their fringe urban markets. And on the retail side, it's again everything else versus the malls. Malls pretty muted, but starting to get some pretty robust rates of return outside of the mall space. So maybe just picking that kind of retail variation apart with the yield versus cash flow. And on the non-mall side, this is where we have started to see appreciation come through in the last couple of quarters. Most of that is on those blue bars. You can just about see that above the line. So cash flow base, the reopening. But we are starting to see some positive price adjustment. I guess that, Robbie, that goes back to what you were saying earlier about the transactions we're seeing. Do you want to kind of comment on that, and maybe also to what we're seeing there on the malls?
Sure, I think the non-mall side, you start seeing a lot of transaction out there, right? So especially the grocery anchor kind of center, and even some nice, better power center. There's a lot of transaction in there. Like NCREIF indicate, like you look at the fourth quarter data, is 1.4 billion with disposition, right? So which means there's 1.4 billion transaction on the non-mall side. So versus the super regional and regional mall, that's a little bit still the unknown, right? So they're bouncing around the bottom. So there's going to be some relatively flat. There's individual asset specific that make it kind of the regional mall kind of up and down generally, right? So, but we see overall on the retail side, you start seeing some stabilization and some movement in transactions. So even with the uncertainty with Omicron and all the other situations as well, right? So,
yeah, and I guess the positive across the board is those blue bars above the line. So as we're starting to see gradual reopening, starting to see those cash flow positions come back a little bit, maybe a little bit more in Q3 than in Q4. So maybe there was a little bit of a stuttering there associated with Omicron, but those cash flows are moving in the right direction, although making relatively slow progress. But there's upside to be taken from that chart. Let's kind of close off by just kind of focusing a little bit on that geographic region of other, as we call it, outside the 15. So we break everything down to 15 largest CBSAs, and then everything else is kind of collected together in other grouping. And this is just looking at some annual performance numbers to the end of last year. So Odyssey overall was delivering a 19% return. That group would call them non-primary markets, 21.5. So there's definitely a strong pocket of performance to be had in that grouping. Apologies, and I think we used this slide last quarter. There's a ton of detail here, so I'll just try and navigate to the salient points. I think the first point to take away is just on the structural makeup, and so there's a little bit structural influences playing into that higher return, because the grey is the industrial, and that's how much they account for of that region, that other collective, and it's a higher proportion there than it is in the overall Odyssey as a whole. So they have a higher exposure towards that industrial strong performing property type. So some of that 21.5 gain over the 19 is a structural piece. But then you look in like for like variances on the last 12 months in terms of the returns across the overall versus within that other grouping, and apartments definitely seeing a stronger return. 23.2 plays 19.5. Offices, no, 5.3 against 9.1. That's quite a significant uptick. I don't think we really want to be beating up on a 40% return for industrial. So maybe we just look into the apartments and the offices and just kind of identify those markets that are coming out with those stronger performance numbers. I think I alluded to it before on the apartment side. It's like, so we just folded up the markets where on the multifamily side there are exposure to some of these markets, and really we're picking out here what is it, an assessment of really some of those Sunbelt markets, the Durhams, the Charlottes, the Nashvilles, Orlando, Tampa, Raleigh, and they're all sitting north of that 19.5% sector average, and those typically Sunbelt markets, following on from what we saw across the larger CBSA markets. If you go into the offices, now 9.1 plays 5.3 for the year, so that's quite a significant kind of positive variant. And so what are we picking out here? Charlotte, we're picking out Austin, San Jose, Minneapolis, St. Paul, all coming through north of that overall 5.3% line. And Portland's the one that kind of dampens things down there, but pretty much the rest of these are all, I mean, they're all up to about 10% rates of return for the last 12 months, and that's higher than, say, for example, Boston was achieving. And I mean, this is a grouping that's about 15% value of the overall office market, so not to be sniffed at. So maybe just your thoughts on what's triggering that, Robbie, and maybe your thoughts are just kind of maybe a note of caution about what we read from this as well.
Sure. So this also showed the non-CBD market, right? So we kind of said the right. CBD are lagging versus non-CBD. The other thing as well, when you're trying to narrow it down to individual market, the size could be smaller. So individual asset here and there could have kind of swing the number relatively connected in that specific market. If there's some lease up to a long-term tenant, that will definitely increase the value here. So there's a lot of individual asset specific that make the movement. But yeah, it's overall still telling me that like a lot of Sun Belt market, like a lot of the urban market kind of closer to the metro area that kind of matter as well, right? So and a lot of individual component to it, they kind of tell a lot of different stories.
Yeah, and obviously everybody we work with on a comparative basis when they've got properties in these regions, we do the like-for-like comparison. So we'll be talking through that with our clients over the course of the next few weeks. Okay, I think that gets us through the deck, and we're doing okay for time. So Rick, I don't know if there's questions coming through the wires there. I mean, the takeaways I think are pretty self-evident. I mean, we keep saying record returns, and we're saying it again. I think that, I mean, a real notable number is the fact that those values are up over 11% now from where we were at the start of the pandemic. And do have this kind of almost, Robbie alluded to, this perfect storm type environment, but there's a lot of diversity out there, across the sectors and within the sectors. The apartments have shown that there's been some setbacks there, again on some of those gateways. Sunbelts are powering ahead. I mean, while everything is strong on the industrial, there's still some runaway leaders there stealing the headlines. Southern California markets, New York, New Jersey. And then on the office and retails, though, I mean, I always want to take the positives from this, and there's positive pricing moves. Cash flows starting to strengthen again. Still net deficits over the period of the pandemic, but there's some positives and maybe some things to watch. The non-malls, the non-CBD offices, things outside those top 15 CBSA markets. So we will, as I say, over the next few weeks, be going around talking to all of our clients and looking at their portfolios against these numbers. But hopefully that's been a useful insight into our read of the Odyssey, utilizing our valuation data to kind of glean a little bit more insight. So thanks so much. Maybe back over to you, Rick.
Good. Yep. Thank you, Phil and Robbie. Yeah, we have several questions in here, and actually a lot of suggestions or comments on additional information that could be provided. So thanks everyone for that as well. We'll definitely consider that as Phil and his team continually modify this over time. So we're definitely open to more suggestions. Several questions here. Maybe first of all, just on this CBSAs that you show, the top 15. Maybe this is to you, Phil. How do you determine which CBSAs are the top 15? There was a comment. One of the questions or comments is, is I think it was Phoenix and Austin and San Jose are not shown in there. Yeah. Is it? Yep.
Yeah, I think that there was plenty of debate at the start. We aligned this with NCREIF, and we looked at the 15 largest that were in terms of values and property counts across all sectors. So I think when you came to something like Phoenix, I think when you look at the office market, think, well, why is Austin in? Why isn't Austin in and Phoenix out? But then Phoenix was in because of its multifamily exposure, and we've tried to stick with the same CBSAs across each of the geographies. But that's kind of a great bit of feedback as well, because I think we've been questioning that as well recently in terms of we maybe should select a different kind of setting of CBSAs for each of the different sectors. But it's kind of trying to get uniformity across the sectors in terms of also then getting the largest CBSAs work across all of them, which does mean that something like Austin on the office side does fall into that other, which is why we've done that work at the end to open that up in a bit more detail. But we have started to think about whether we should mix it up between the sectors as well.
Good. Robbie, maybe this is for you. You gave the weather report for Southern California, warm and sunny, although it's only about 63 degrees, so not quite warm, but warm and sunny. So the question is it too hot? Is it, when it comes to industrial, I think we had 2 quarters of 20% return in Inland Empire industrial. So what's your Doppler weather forecast going forward? What do you see for industrial? Yeah.
And the whole thing is the vacancy, right? Like, for example, Inland Empire 0.7%, right? So that's really pretty much full, right? So the issue when that happened, what is the market rent? I don't think anybody can tell me what is the ceiling for market rent yet, right? So the rent continued to go up. And even the other thing as well, if you look at it, the total occupancy cost is actually less, about 5% of total supply chain cost for the tenant, right? So that occupancy costs are not a major number. So what the landlord been able to do is increasing the rent on all this market, right? So we know that we need to get to the port, and port you need to park it somewhere. So then you get that LA and Inland Empire. To some extent, it's continue on as well. You see that going on in Phoenix, you see going on in Las Vegas. We just need more space on industrial side, right? So I don't know what's the ceiling look like on market rent. Like a lot of cases, it comes from fundamental. And that's pretty much what's going on right now. And the supply side is not coming fast enough, right? So you're not basically, it's not enough new supply in the market to to address all the demand on it, right? So you get the just in case demand, you get the existing demand, and then you get more sales. The retail sales are up, and then yes, the percentage on online is less than the earlier 2020, but it's still higher than previously. And then the gain on the online retail sales still continue to be up as well, right? So we know that 1 square footage on retail is 3 square footage in warehouse, right? So that means if you got less retail, you go to online. To go online, you need more warehouse spaces as well. So right now, I don't know, but I know that the rents continue to go up basically right now.
Yeah. Well, it definitely looks sunny too, just when you go to the demand. And I know last couple of quarters have been talking about the number of container ships in the harbor here. They're actually not in the harbor. They're queued up across the ocean because it's now, they say, I think in the queue is about 105 container ships, about 860,000 containers. So that's about 3,000 miles of containers that are still coming to LA Harbor. So it looks rosy, or it looks sunny for the near future anyway. Maybe to both of you, a lot of talk in general. I'll reference a little bit. We'll talk on another webinar that our new acquisition, Reonomy, will be having in a couple of weeks. But from the macro side, economic side, is inflation, interest rates. You know, we're seeing that interest rates are starting to go up, that inflation pressures are coming. Are we seeing that yet in valuations? How is that impacting it? How do you think it'll impact values going forward? Any thoughts on that?
Yeah, on the inflation side, the way I look at it, like if it's inflation due to economy, right? So this is what's going on right now. The other question is, so how about interest rate, right? So because interest rate is NPV, if it's higher interest rate, could be like lower value if you NPV it, right? So, but what people look at it is like real estate always view as a hedge to some inflation number, right? So what it is you can increase the rent as inflation go up. Definitely have impact. In the other positive side to inflation is basically reduce the supply side, right? So the cost of labor is much more difficult. The cost of new construction, so that slow down the supply side. And then right now as well, that with overall the unknown, right? There's a lot of capital flow to real estate, which actually compress the cap rate, right? So I'll look at it basically right now. A lot of people see that real estate as basically more kind of like a hedge, right? So and then as long that the growth of the inflation and then the interest rate are caused by the economy that's kind of growing, right? So, but yeah, so that's how I
yeah. I guess on that, Robbie, as well, that kind of yield versus cash flow trade-off we're seeing at the moment, and it's been just increasing more so on the cash flow side. So I mean, yes, obviously, I assume an interest rate will have some negative impact on maybe some yield levels, but it's the cash flow piece that's been increasing the improvement of the values. So that kind of chimes to what you're saying there as well, Robbie.
Yep, good. One of the questions, I think it was back on slide 4, related to, you know, we talk about apartment returns. This is the allocation across sectors since 2014. If you look at apartment returns, returns have done very well, so values have gone up, as well as interest from investors has increased relative to apartments, but it only changed by 1 percentage point more over that 8-year period, I guess. Any thoughts as to why that isn't more than that? Is that surprising?
I think earlier on, if you get pre the pandemic, the apartment sector wasn't really delivering anything in terms of value change. It was pretty much delivering on just an income return. So, pre the pandemic, I mean, that apartment allocation didn't move at all really from a value standpoint. It's delivering its income return. So I think it's only more recently it's seen that real tick up in values. And then I think it goes to Robbie's point in terms of the transaction activity, and it's just maybe being kept in check just because of the level of growth that we've seen on the industrial side. So that's really been just opening up the weighting, and that's just kind of kept that apartment exposure to an extent that hasn't shot off the scale at this stage. And I mean, it's gone up by a percentage point, but I think, you know, it's certainly been eclipsed by industrials during the period of the last couple of years. And prior to the last couple of years, I think that, you know, the appreciation has been pretty negligible when it comes down to the apartment sector. I think it's yeah, there is maybe a slide that just run back to it.
Okay.
You can see
Yeah, and I think that's a good point, Phil. And I think the other thing too is it probably just the allocation part of it is it probably just reflects just how much industrial has increased, because most of the decreases in office and retail has actually been, taken up by industrial. So probably one more question, and actually a suggestion, but I know you've considered this quite a bit, is the life science and medical office, breaking that out. I know there's talks and discussions about that. Anything you want to update on that?
Yeah, I think we're following the lead of NCREIF on this. We're part of all those conversations as well. So when it does get broken out, and I think the suggestions we're hearing so far is it will be moved, something like life science will be moved into that kind of other category out of the offices. At the moment, it is we do find those properties slotting in across a number of the different sectors. Either mainly they're going into offices, but some are going into other. So NCREIF are discussing this across their working groups, and I think closing on a steer to put life science more into that other category, and we'll obviously kind of follow up and match up with that. But I think that they're not planning to do that until the latter part of this year. So, but yeah, we follow the lead in terms of the conversations that happen at NCREIF. Part of that, making sure that we keep things aligned in that respect. I think they're making their changes in the H2 second half of this year.
Yep, good. Okay, well, a little past the hour. There are definitely other ones here. We'll definitely, as Phil mentioned, with his meetings with all the clients, he'll definitely address, some of those as well, and we'll get back to those that we didn't reach. So, as you see on the slide again, the webinar I mentioned from Reonomy, or recent acquisition in November. They have a quarterly state of the commercial real estate and industry outlook. Some good. So this is the Phil and Robbie show. That'll be the Tim, Brian, and Brian show coming up. So we want to make sure you know about that. And I believe the invites will be coming out shortly. So with that, again, thanks everyone for attending, and we'll be talking again in 3 months.
Yeah, thanks everybody.
Thanks.